I published yesterday, December 5th, 2025, a post discussing my recent trades over the past few days. A link to my blog post can be found in my profile section here at YouTube. I'm continuing to add dividend paying common and preferred stocks to partially replace the decline in interest income that I anticipate from Treasury bill purchases at auction. My current pace is to add $150 to $200 in annual dividend income each week. At the midpoint, $175 per week, the annual increase would be $9,100 after 52 weeks. The Fed is expected to reduce the federal funds range to 3.5 to 3.75% next week, which is not yet fully reflected in the investment rates of the 3 and 6 month Treasury bills. In item 3 to my recent post, I discussed buying a 3-month Treasury bill priced at a 3.813% investment rate and a 6-month bill priced at a 3.754 investment rate. Both of those yields are above what the market is predicting as the top of the federal funds range starting next week, which is 3.75%. To fully reflect a 3.5% to 3.75% federal funds range, the yield would typically be near the midpoint or around 3.625, and that would require at a minimum no more cuts in the first half of 2026. Otherwise, the T-bill yields would be too high now if there were any more cuts than the one predicted in early December 2025. As I said, I expect the Fed to cut in response to a weakening U.S. labor market, and all of the evidence points to a seriously weakening labor market. But I do not expect that cut to have any material impact on the weakening jobs market, since the causes of that problem are unrelated to the current historically low federal funds rate. Lowering the range further is not the cure for what ails the economy now, and to emphasize again, it's not. It's a double-edged sword. Businesses can borrow money at lower rates, but the lower interest rates hurt savers who have less interest income from credit-free risk investments like savings accounts, CDs, insured by the FDIC, and Treasury bills. And time will tell whether that opinion is confirmed by what actually happens. One investment objective that I have now is to, and have for several years now, is to have exposure to high quality municipal bonds, mostly rated AA or higher, with a number of the bonds that I currently own are rated AAA, which I buy all of those bonds in the secondary market. I don't think I've ever bought a municipal bond at the original IPO. I will generally aim for $8,000 to $10,000 in annual tax-free interest income. This requires me to replace municipal bonds that mature or are called early, and I've had several called early. I discussed in item 2 of my recent post buying 5 of the Harpeth Valley Utility District AA2 rated 4% water and sewer revenue bonds at below par value. The security for the bonds are water and sewer revenues, which people tend to pay on time. The service territory for that utility district is in Williamson County, Tennessee, one of the richest in the United States, and Forbes once added it recently at the 10th wealthiest county in the United States. So the risk is not that high. the credit risk. The interest rate risk is high. To receive a current tax-free yield of more than 4%, I had to assume more interest rate risk by going out to a 2044 maturity. I noted in today's post that this issuer has called bonds early that I owned both in 2024 and earlier this year in 2025, which at least suggests to me a willingness to call early bonds, which reduces the interest rate risk normally associated with a bond maturing in about 19 years. The normal call protection for a municipal bond applicable to all the bonds that I have owned and own now is 10 years from the date of issuance, give or take a month or two. And this bond cannot be called until September 1st, 2034, indicating that the original issue date was last year. The one called by Harpeth Valley earlier this year that I owned had a 3.2% coupon that would have matured in 2038. I realized a gain of $472.65 when that one was called, and included a snapshot of that gain in my 12.5 post, as well as the snapshot of the gain for the bonds that were called by this issuer in 2014. My approach to investing starts by defining my goal, which what I need to achieve as far as my investments go, and then how to achieve it based on my risk tolerance now, which is currently low. My goal is simply to generate enough income after the federal income tax, and there's no state income tax in Tennessee where I live, so that I will not have to dip into the principal amount of my total portfolio to pay expenses, but can pay all expenses, including extraordinary expenditures like the new roof I recently installed at my house, with my current dividend and interest cash flow, along with realized gains, which includes realized market discounts on bonds, which will be high each year, capital gain distributions from stock funds, and trading stocks as well, providing a cushion when interest income from new purchases is declining as they are now. Having defined that objective, I devised means to achieve it through assuming the least amount of risk possible to achieve the goal. Some risk assumption is required. I devote a fair amount of time to developing strategies to minimize the risk that I do assume. That would include, for example, having a heavy weighting in treasury bills and using a bond ladder strategy weighted in the 2 to 3 year average duration and focusing only on investment grade bonds. So far, I've had only 2 bonds rated investment grade when I purchased go into default, and I have and own hundreds of them now and have in the past. For stocks, the risk mitigation starts with what I call a small ball investment strategy, referring to baseball, small ball, where positions are started out small, mostly in dividend-paying stocks that have yields over 4% based on my original purchase price, averaging down and then selling my highest cost shares profitably, which reduces my average cost per share and increases my dividend yield for the remaining shares. I use a contrarian value approach, which is best suited to my personality, which means in practice that I'm not buying stocks hitting new highs or anywhere near their new high. So in summary, I'm not swinging for the fences and I'm cautious in taking a risk with my investments. That needs to be taken into account when reading my blog post. I would like to note in in concluding this video that President Trump pardoned the former president of Honduras who had been convicted by a U.S. jury after a 3-week trial of importing, as I recall, 400 tons of cocaine into the United States. And this was done soon after he started a 45-year prison term. Trump claimed falsely that the former president of Honduras was convicted of trafficking drugs in Honduras. That was not what he was convicted in the U.S. court of doing. He was convicted of transporting cocaine into the United States. Yet, and this is very disturbing to me, Trump justifies the boat strikes in international waters near the coast of South America based on a claim that the Venezuelan government is behind the criminal organization that is transporting drugs into the United States. Republicans in Congress who have significantly less bravery than a chipmunk cannot utter a word of criticism of Trump and his pardon, or the Honduran former president, or the double tap strike on 9/2 of a boat that was not even headed to the U.S. And I'm not questioning that the boat contained drugs. I think it probably most likely did. And that is just disgusting, but it is normal now for Republican politicians in Washington not to say anything that could be interpreted as even the mildest of criticism of anything Trump says or does.